Great. I think we have a quorum, and folks would keep on joining in. So I think we can start. Sanil, thank you so much, for your time, for this session and for the community. Uh, I think I'll begin with just a quick round of introduction about myself, and Sanil would love to then have an introduction about you as well. Right. So, guys, my name is Karan. I run Accelerate as a passion project to help young founders, in their journeys to help them grow, as well as, we run this community of super angels to help people like you kickstart their angel investing journeys. Apart from Accelerate, in my full-time role, I work at Meta. I lead marketing for Meta in India. And before that, I've been a two-time founder, so pretty close to the startup ecosystem in the country. As part of this series, we're doing these sessions with some of India's best investors to get their views on angel investing as an asset class, what got them into angel investing, how does one think about building deal flow, planning exits, what are common mistakes that people have made. And the idea of this series was so that we can learn from the best and kickstart our journeys. And talking about the best, today we have Sanil with us, who's the co-founder of Huddle Ventures and the managing partner at Huddle. Huddle is one of India's best early stage funds, institutionalizing early stage capital. They've invested in some iconic companies like Perfora, Boldcare, Blue Tokai, Celsius Tech, and so many more category defining companies. So, Sanil, thank you so much, for your time. I know I've not done justice with the intro, so would love an intro about you, about your investment journey, and then we can take it from there.
In fact, you've been too kind. I think you've put a lot of pressure. But thanks for having me, and thank you for everyone who's here on a Saturday morning, and those that will be listening when you share it across your network. So, just as an introduction, I'm Sanil Sachar. I'm one of the managing partners at Huddle Ventures, which is an early stage fund. I've been personally investing in the private or the startup space since 2016. Prior to that, and even after that, I've played the role of a operator myself in a couple of entities before my co-founder Ishan and I set up a Huddle originally as an incubator, then managed some very large-scale accelerators in partnership with other corporate venture arms, funds, folks like Mondelez India, and then launched Fund One, and now we're investing out of what is Huddle Ventures Fund Two. My journey in investing has been, I mean, it's always going to be a day one journey because there's so much learning that comes with every facet of investing, every facet of seeing how your companies grow, and then most importantly, creating exits. I've invested across early stage. I've invested fairly later in Series D, E rounds as well, in my personal capacity. And as a fund, we've maintained how to play the role of a significant lead investor for our startup. So I'm happy to share all my learnings, and more importantly, also learn from each of you all of what you've faced as key wins or even losses during your time here.
Amazing, amazing. So, Sanil, I think we'll keep the session, very question answer based. Folks, if you have any questions, please feel free to type in the chat box. You can raise your hands and we can take them, through the session. I think I would love to begin by understanding, like what got you, into, you were an operator, you were a founder, and then you started investing, right? And eventually, then the transition to Huddle happened, and you launched a fund as well. So, what got you into investing? Was it a very exciting asset class? Was it intellectual simulation? And I know that it's different for everyone. So, like, what was the key inspiration for you when you started angel investing?
I mean, the way I look at angel investing is, or why I angel invested. I think firstly, I didn't know it was classified as angel investing when I first did it. I think it's a very, very pretentious name given to something that you want to be a part of. So I think the term angel should be removed from angel investing. It's really,
Startup founder should be angels.
yeah, that's a damn good point you've said. Absolutely. Uh, that being said, why I first parked capital with founders was because I wanted to be, I was a key believer in some of the founders I first backed, in terms of just their energy, the kind of the kind of vision that they had. There was a sense of obsession in what they wanted to do, and the way I looked at it then. And there's actually a correlated point to how I look at it now as well when I have personally invested, or a part of when Huddle invests, is we just want, it's like investing to be a part of a very exclusive party. You pay, you enter, and you experience it as it grows from being just the party organizer and you as the first guest. And then you see it turn into something more lively as the hours, or in their case, the years go by. And maybe you add to that journey by inviting other right people, organizing the room inside, which is organizing their company. And over time, you learn what are you good at in that party and what are you not wanting to get involved in. So my first encounter was, how do I get involved with these founders who are just great hosts of their party, i.e. their startup, and how can I help them? Um, and that was it. Now, when I have to just, one more part of elaborating on that is, then you soon start realizing a key trend in the kind of founders you want to work with, the
Hmm.
kind of founders you want to back. And it's really, when you're first investing, it's really about finding the right table you want to be at. So I often, and I say this to anyone in the VC ecosystem, as much as you believe the founder needs to quote unquote pitch to you, you have to pitch to the founder, right? You have to and by pitching, you mean you have to be curious about what they're doing. You have to ask the right questions. You have to suggest certain things without it coming across as gyan, because I believe that being a part of someone's cap table is not only the responsibility of the startup, but it's also your responsibility, because it's your capital. You need to make it grow, and you need to be able to do everything in your control to see it grow without being a, de- a deterrent to the growth of the startup. So it's a very fine balance, which we can get into as we talk about growing your portfolio.
Interesting. So I think you mentioned two very interesting points. So one obviously is being a part of an exclusive community, is building your network, intellectual simulation, and then also deciding I mean, like which founders to back, and where you can add value and where you can't, right? So like I mean, how does one go about building their own investment thesis, right? Like how did you go about doing that? How did you decide that like I want to invest early, these are the type of founders, these are type of sectors I want to invest in?
Yeah, it's a great question, because I actually have two different answers, from how I invest as an individual investor versus how I've invested, more importantly, on behalf of my investors as a GP. See, as a GP, as a general partner to a fund, I don't ever want to invest in anything where I have a cost of learning personally. I don't want to invest where I have to learn the early stages of that growth of the startup. We invest where we have a incredibly high conviction of, obviously, the founder, but also the space, the sector, this product or the solution they're going after, and how can it possibly mature, what could be potential contingency plans. Because when you're investing someone else's capital, it's great. There was someone who gave me this great advice, and I hope to pass it on, that you then invest on behalf of your most conservative investor. Think about them.
Hmm.
And therefore, we're thinking about them. It's not about playing conservative. I think we all know this asset class has a lot of risk and unbelievable rewards. But they're both as probable or improbable as well. Um, that being said, when you invest on behalf of your most risk averse investor, you're essentially creating contingency plans that can help your startup grow, that can help your startup, more importantly, not face mortality. And as I like to see it, help your startups not compete with startups and now compete with larger legacy players. So, how do you make your startup not be identified as a startup anymore?
Hmm.
When I invest as an individual investor, I think the themes that I have created are it's varied, and it varies with the kind of exposure I take in the ticket size maybe I look to invest. So where I have a very high conviction, obviously my ticket sizes are naturally larger, because I believe I can help steer the journey, can help add value to my founders. Where I believe I want to learn, I narrowed my check down a little bit, and I'm very open with the founders about what I can or can't do, or what I do or don't understand. I think you know that kind of clarity to your founders, especially if you're investing in the early stages, is critical, because then they understand who they want to leverage on their cap table, and
Hmm.
how do they want to leverage it. When I've invested at a later stage, frankly, when I mean later, it could be post Series A, around a Series B, C stage. I believe at that stage I need to sit with the founder and understand their unlearnings. It's critical, right? Because how have they matured in their journey to go into this new learning curve, right? Typically, a Series B, C inflection stage is where you're now catering to a very new challenge in your journey. It could be the kind of competition you have. It could be your CAC, your cost of acquisition increases. It could be your distribution channels are new. So how are they going? How have they matured? Are they the only people running the show still, or how have they delegated their growth? And then I do a risk to reward, just comparison, right? And here now you're playing on data. You're playing on their past data. So it varies. I think thesis building is a very it's an exercise I would urge everyone to keep, every few quarters, be it 3 4 quarters, evaluate again.
So it
Don't
evolves.
Yeah, sorry.
So it evolves, you're saying.
It has to evolve. I think, the same way, trends change because of consumption patterns. And if we believe consumption patterns don't change, and consumption could be in B2B or B2C, if we feel consumption patterns aren't going to change, then I think we're all fooling ourselves.
Hmm.
It's very important to ensure that you are reevaluating your thesis. And how to practically do it is, after a couple of years of investing, give yourself 18 months of investing, be it in 3 startups, 4 startups, whatever you might have invested in, and evaluate them on a simple Excel, and see how have they grown,
Hmm.
how did you evaluate their growth, just so that you can match your understanding to what's actually happened. And over time, when as investors, we start recognizing and seeing realized exits, right?
Hmm.
Because everything else is very unrealized. It all looks great. I like to believe unrealized IRRs are like a great cloud that seems like it's going to rain, but maybe it's just false thunder, right? But how do you really get the rain? How do you really see your exit? Evaluate yourself then. And then you'll start realizing, where do I want to hold my thesis? Where do I want to now learn something new?
Interesting. Interesting. I think you've touched upon some really important points that I think we'll cover. Angel investing as an asset class, right? Like you've talked about portfolio building, the like check sizes in sectors, like what stages. We'll talk about that. We'll talk about exits. We'll also would love to learn a little bit about your mistakes and like what you have learned in your journey, and which like early stage investors can avoid. So because a lot of us here are investing for the first time. I mean, it's like for us, like it's like maybe like 2017, 2018 for you when you just started investing, right? So a lot of it is new. So would love your experiences on that front. So I think Sanil, first question I would love to ask in terms of portfolio building, right? Like essentially what should be an ideal check size? I mean, like how many companies should one invest in a year? How much should they park for angel investing? Should it be like more of a spray and pray that you kind of like invest in 30, 40, 50 companies a year, or should you only invest in 4 or 5 that you feel are the best? So like how can you suggest, like from your experience, like the best portfolio strategy in terms of angel investing should be?
Yeah, this is a it's a very relevant question you've asked, but unfortunately, there is no cookie cutter model to finding success here. Some people do like parking many checks, and playing a probability game. Some people like taking depth. in terms of how much ownership they want. Um, how I like to look at it as an individual investor is creating diversification in the stages I've invested in. So if I attribute 10 rupees as my total corpus, I think it's not my I don't think it's my place to state how much a check size should be. But before I get to the breakdown of 10 rupees as a portfolio, I would say that as an angel investor, you're more often not to play the role of how much you own in that portfolio, because you're more in most probability going to be investing in partnership with other funds who as funds we look at ownership criteria. We look at 10, 15, 12%, whatever it might be, because we're creating a portfolio construct of our entry point, evaluating our exit timeline, something that we'll certainly touch upon in this conversation today. So if you're backing these founders in most likelihood with funds, syndicates, angel networks. However, obviously, there are enough friends and family rounds that take place as well, which is in many cases the first round also for founders. In those cases too, I'm speaking for the mass audience of angel investors. It's not about the ownership you hold there. Obviously, it becomes important. You might want to hold 2%, 3%, 4%, but I think it's important to have a certain portfolio mix, how I like to look at it, across stages and across sectors. Now, why am I speaking about these two diversifications as an angel investor? Going back to the point I was briefly mentioning, see, when you're investing early, and early defined as pre-seed seed, there's a risk attached to it. There's a risk attached to traction being created. There's a risk attached to the ceiling of that traction. And obviously, there's a risk attached to, for many reasons, unfortunately, if you look at data, the teams breaking up, founders having disagreements. Many a times it's a software element in the early stage journeys why founding teams or early stage teams crumble. Therefore, there's a risk attached to something you have no control over as an angel investor, whether you like to believe it or not. You
Hmm.
won't have that much control because you're not, and you should not be a part of the day-to-day journey.
Hmm.
You should only be a part of the day-to-day struggles when they come. If you can add value, add value. If you can't add value, please observe and leverage your network. My biggest advice is don't believe you are steering the ship. It
Hmm.
is not your ship. I'm saying this for the people that believe it's important to get involved, to involved. Coming back to the diversification element, it's important to understand that risk and therefore gauge what that 10 rupees means to you. Now, see, family offices have gone, if you look at the data, have gone from anything from putting 5% of what they can afford, in this asset class of their net worth to 15%. Some obviously gone up to 20%. I have seen an average of anywhere between 7, 8, let's round it up to 10%. So if you're saying my net worth and I'm trying to put in anything between 7 to 10%, then look at how you want that return ratio to be probably created. Now, yes, there's obviously a mindset, and we've heard this a lot from people to say, invest what you're willing to lose. I second that absolutely because of two reasons. One is the feedback loops of getting a return are long. Let's be clear about that. Yes, when it comes, it's incredibly rewarding. It's an incredibly rewarding return, but there is a large feedback loop and a long feedback loop. And in that feedback loop, there are many more companies that will fail than that will succeed. Again, this is something that you need to be open with. Why? Because in this journey, when you're diversifying across early and later stage, the earlier stage companies will always give you the highest returns. Factually as well, if you look back, early stage funds will always outperform late stage funds in terms of their multiples of growth. Yes, mortality will be high. So now look at, hypothetically, I look at it by saying 3 to 4 rupees I'll put in early stage as an individual investor. As a
Hmm.
fund, I'm happy to put in 8 to 10 out of the 10 rupees in early stage.
Hmm.
Then I put in post series A to B or C another 3 to 4 rupees, because the index changes, but the index of mortality changes, but the index of matrix, or multiples also changes, right? It
Hmm.
could reduce.
Hmm.
So now you're trying to talk about probability. The remaining 3 or 2 rupees, I actually like to look at debt as an asset or
Hmm.
venture debt as an asset. And obviously I'm not here to talk about public equity or not even talking about pre-IPO opportunities. I think venture debt can play a really large role in creating some sort of principal return for angel investors. It also teaches them a lot about how sectors are growing, because when you're investing in debt,
Hmm.
you're actually seeing certain trends, how the repayments taking place, where there's defaults taking place. So you're actually learning from a quicker feedback loop.
Hmm.
Going back to what we were earlier discussing, how do you build your own thesis? I think you have to build your thesis not only through reading and practice by where you are involved, but also diversification in the asset class.
Hmm.
So these are largely elements where I how I look at diversifying. Now, whether it is 50 investments or 10 investments, I think that's everyone's call. My personal angel investment thesis is, trying to look at, between 8 to 10 investments a year. There's no there's no reason for it. I rather take more depth in, obviously, as a fund manager in my investments, and wherever I don't have a conflict of interest, only will I invest, which typically turns out to be later stages.
Hmm. Hmm. Interesting. No, I think very valid points. My strategy is a little different. I invest about 20 to 25 in 20 to 25 companies a year. My check sizes are small, right? And my sectors are defined, as I said, consumer, internet, enablers. And generally I come in on the first round, right? So essentially, like it's like pre-seed, seed, like the first round, and then essentially try to help founders with, because of my background in terms of helping them with CAC, with their growth, and essentially with their customer acquisition wherever I can. And
Yeah.
I love your quote that you're not the sailor of the ship. Yeah, I mean, like, so I mean, it's important to not really give a lot of unsolicited advice, right? Like wherever founders kind of need you, they'll kind of reach out to you, and
Yeah.
that's the best way to look at it. But interesting. And I think you also mentioned about venture debt, which is also interesting. So, would love if you can just maybe compare different asset classes for us, right? So essentially, like what are the kind of returns that normally people have, and you would have seen in your experience in angel investing, realized returns, versus, let's say, a venture debt as an asset class, or then comparing it to more established asset classes like, let's maybe like mutual funds or real estate, or any other like pre-IPO opportunities, if you've done so as well.
Yeah, I mean, see, the when we talk about real estate as an asset class, that's a very different mindset. I don't think my suggestion is don't come with the real estate invested investors mindset when you're investing in um, even early or late stages. Real estate definitely has its protected layer for you as an investor. I've invested across real estate with that mindset that it's a safer investment. I mean, as safe as it can, any investment can be, but it's all, there's also a realized cap of how long, how far can this really give me a return, what kind of multiple can it give me. When I've looked at See, I think when I look at my own portfolio today, my realized exits are today hovering between, and I don't like looking at IRRs. I rather look at multiples, because it's a simpler way of
There's
evaluating
multiples on invested capital.
multiples on invested capital. For the 10 rupees, how much have I made? Because I think IRR calculation as an individual investor, I look at on my overall portfolio. I truly believe in the multiple as an individual investor. I'm speaking,
Hmm.
right? For my investors, yes, IRR is very important because they evaluate the money they're putting in a Huddle Ventures or with other funds versus what they could have gotten if they put the same 10 rupees somewhere else, right? So as an individual investor, my portfolio is a little on a multiple side. When I look at realized and unrealized, on the realized side, if I look at my total portfolio, it's roughly around 6.4, 6.5x of
How,
invested capital.
this is
The
over what period?
This is over, if I'm looking at my last 5 year data,
Okay.
4 or 5 year data of investing.
Yeah.
That being said, I'm still holding on to some of my investments since 2017 and 2016, consciously so. Right, as an individual investor, it's a very different mindset where you want to hold on to some of your ventures. I am a firm believer
Hmm.
that you should create and try and leverage earlier secondary exits partially and
Hmm.
then hold on for longer. The reason why I've been able to command, 6.5 hour decks and create this return, um, both for my investors is where I'm speaking actually when I speak about this return, is because we have always believed that when founders go through a newer learning curve
Hmm.
and you have entered at a certain earlier learning curve, if you get the opportunity to partially exit, take it. That's not you losing belief in your founder at all.
Hmm.
You're just leveraging the delta of one learning curve to the other, which typically is a very large hike of multiple from when you entered to where they are today. So take that out, because the way I look at it is that the risk of capital typically restarts at that new junction where the founder now has to learn again. When I mean learn again, I mean where they have to play at a newer playing field, right? Newer competitive field. So if you have entered at pre-seed and you're holding on till series B, sure, the person who holds on till beyond series B gets themselves an exit, is at a position where they'll always have a better multiple to what I'm advising. But the what I'm trying to safeguard for every angel investor here is that in the circumstance the venture were to not succeed,
Hmm.
have you been able to take out capital, create a return? Because at the end of the day, sure, you are backing these founders and you believe in them, but your money is your money. This is
Hmm.
you have to protect your capital. And if your risk appetite allows you that, I there are many investors and I really respect them, that says I'm going to forget about this capital, I've invested it, where this goes it goes. Those are incredibly risk proact investors, and I think that's awesome. It's awesome for
Hmm.
the founder, it's great for them also, because they are the peace of mind that अगर ये zero होगा, अगर ये 1,000 होगा और इसके बीच में सब चलेगा. The
Hmm.
second is the founder, where I'm just trying to create a ratio to saying that can you take out some capital because you didn't invest with the Series A investor mindset. If you did, maybe start investing at that stage where you're saying, I don't want to take so much risk. I'm just trying to ensure that you all get your returns uh, in a manner where there's some money off the table, and then everything over and above that is a larger win. And we have
Hmm.
done this multiple times over as individual and managed investors.
Interesting. I think realized returns of 6x over a period of like 6 to 7 years is like insane. Like that's like almost 3x of what you get in capital markets. So and that's just the realized returns. Like you're not even talking about the unrealized ones.
Yeah, I don't want to talk about the unrealized ones because unrealized today, fund one, and I'm not shy in sharing any numbers, is unrealized at a 55%, but that's unrealized.
Hmm.
I think it's 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 great to know that you can create that delta, but
Yeah.
the journey of an investor is not investing. The journey of an investor is not investing and portfolio building. The journey of investors investing, portfolio building, and exiting. You're
Yes.
truly an investor once you've truly experienced investing, when you've done that, when you've unfortunately seen write-offs, when you've seen returns. So I think it's great to know you can create unrealized returns, but it's better to know that you can leverage them, that you've been able to create value, because that's why we're investing. This is not philanthropy, right? I mean, we are doing this because our money has to be at use somewhere. It could have been somewhere else. That's when IRRs come into place for my investors.
Yeah, I think Sanjay Mehta, he has this very famous quote. He says कि जब तक आप exit planning नहीं कर रहे हो, तब तक आप एक donor ही हो. Like essentially, you become an investor when you start looking at exit planning as well, right? So if you don't have an exit, then you don't are not really an investor. So
Yeah,
so I
great.
think coming to that as well. So like, how does an angel kind of look at exit planning, right? Like I mean, like maybe and we'll talk about getting into a deal and investing, but like since you've touched upon the topic, like how does one plan exits, how do exits happen, because it's not a very liquid asset class. So how can, as an angel, as an individual investor, you can kind of enable exits in your portfolio?
It's a great question, and largely because we there's a common see the most common way of getting an exit is where your founders and the companies are raising successive rounds, and they've reached a stage where cap table starts getting cleared, which means a larger investor is now coming and investing on behalf of their investments. They do a blended round, which is a primary entry and a secondary, where they start then giving returns to investors that came in earlier. Sometimes you have no control and you have to exit, even if you want to hold on, because the this is it's in the benefit of the company. Maybe the ownership that the fund wants is larger, so you're a little restricted. That's where the issue of, as you invest earlier, the rights that you hold start diminishing in most probability, be it your preemptive rights, be it your your liquidation preferences might will in most likelihood reduce, and therefore a clearance of cap table comes and you get an exit. That being said, what I have seen and what I would suggest others to do, which I really do all the time, is I get familiar with my cap table. So you get a shareholder agreement by the end of the day when you've signed. You should know who else is invested in the company. The reason you want to know that is for two reasons. Call it portfolio A that we have all invested in, and everyone over here who's listening and will listen later is an investor in company A. Now, Sanil might not be the happiest investor, and let's say Vijay on the call here, or Gaurav on the call here are happier on that cap table. Can they be in touch with me, know how we're growing to be able to acquire my shares? Can they leverage that insight to be able to get larger ownership? I'm not talking about exit here. I'm talking about
Hmm.
larger ownership. Yes, in that return, this gives me an exit. Now let's reverse the scenario. Let's say where I am in a conversation with them and I recognize that they're seeing something and they're more bullish about a longer tenure and I am not. If I can be vocal, right, by the end of it, we all are invested in this asset. Someone wants to either someone wants to maintain and increase, and someone wants to exit. There's no other fourth scenario in this. Therefore, if you can gauge these three scenarios, you're either going to be able to get an earlier entry point or a earlier exit before any exit event. Maybe you lose out on an upside, but at least you're getting what you want. Or you get more ownership without you realizing that you could get it before that next event where you are anyway going to get liquidated or diluted. So I think it's all about being informed and staying informed with your cap table. What this also does is it creates an incredible network. This will probably be your source of next deal flow, these people that you've invested with. Because if you've been able to, look eye to eye and agree on portfolio A, what stops you from believing portfolio B, C, D will not come from the cap table that you're in? Because now they know your appetite. They know you could fill rounds with them. So it's a ripple effect of many positives, not just the objective of getting an exit.
Yeah, this is an incredibly powerful insight. I think, thank you so much for sharing. I think this is like a secret sauce of
It
yours
was.
over the years, right? But like very powerful. Like I have personally not been doing this, and I've been investing for the last 3, 4 years actually to get to know your cap, like other investors in the cap table, build relationships with them, understand what how are they placed on this deal, whether they want more liquidity, like whether they're looking at like holding more, and like that becomes like your potential source of exit or acquiring more stakes in a company. Very interesting. I think coming to the other side, Sanil. So, like, now, how does one build great deal flow, right? Like, if I'm just starting early, right? Like, so we've talked about exits, we've talked about, we've discussed angel investing as an opportunity, as an asset class. But how do I get the best founders to start reaching out to me? How do I see those opportunities? Where I can, have an invite to the coolest party, in town.
Multiple avenues. I think that one that I'll start with is something that a lot of people are starting to do, but it's important. Is be a little more opinionated in forums like, be it a LinkedIn, or where if you're in an angel network, about what you what you believe in, right? What kind of sectors you want to see. I think the more you voice yourself about themes, sectors that you're bullish about, the more likely you're going to get known for in that founder circle that's
Mm.
building. Because it'll become that, okay, go to the team at Accelerate because they love commerce enablement, right? Because you're vocal about it. So I think building your presence, building your brand, what you stand for, what you firmly have a conviction in, is important to just vocalize. That's one. In the early stages, I've invested directly. I've invested via angel networks. I've been a part of other people's syndicates. I've run my own syndicate. Then obviously, fund one, fund two. But it's important to, in the early stages, it's helpful to sometimes piggyback on someone else's tailwinds of their investing, right? Why? Because maybe you should always, if you're investing on behalf of someone, on behalf of yourself with someone syndicate, know the person. I firmly believe it's important to know the syndicate at the other end. It just helps you with the kind, you'll understand the fund manager's mindset. Because when you're investing in a syndicate, you're not controlling your exit. They're controlling your exit in 99% of the cases. Which means you need to understand how are they looking at exit creation, and then believe, do they even have the ability to take the help the company get there? Will they take the right call at the time? Are they going to be conscious? Are they going to be greedy about their decision? Learn these facets when you're backing someone. The other part is, they will understand what your appetite is. Again, they'll start sharing more deals with you. I think the more founders you end up talking to,
Yeah.
here's the other learning that I've had: transactions or the financial part of being an investor actually only happens twice. Transactions only happen twice, at entry and exit. Everything else is relationship. How you source the opportunity, how you talk to the companies, how they perceive you, whether you invest in them, so your evaluation phase, and how you are once you've invested in them. Here's the other part of this. Therefore, I have said there's two transaction parts of this and three relationships in this scenario. So relationships are trumping the transaction bit. There are more companies will say you will pass on, and you'll say no to, then you'll say yes to. It's how you evaluate them, how you say no to them, that will also be a critical part of how you get represented in this ecosystem.
Mm.
Because founders in this ecosystem are a very close knit. They do huddle together. There is a very core ecosystem there, and rightly so, because unfortunately, their journey is about capital raising in the early stages. So they don't want to be with someone who's going to be an ass to them. They want to be with someone that will respect them. Us investing, like we've discussed, is us being a part of their party, not inviting them to ours. So it's how
Yeah.
you manage this that will help you build your reputation as a enabler and not be known as an investor. I think being known as an enabler is better than being known as an investor, because the investment part of the journey is great for you and when you're managing for your LPs.
Yeah. Yeah. I think very well said. Like one of the best pieces of advice that I got when I started investing was that life is never about exchanging dollars, right?
Mm.
So like, and I think you also mentioned that the transaction part only happens twice, but the relationship trumps the transactions, right? And I think the best piece of advice that I got when I started investing was somebody told me that just meet 2 to 3 founders slash investors slash enablers in the ecosystem every day, right?
Mm.
And when I first heard this advice, I was like, this is insane. How can somebody meet 2 3 new people every day? But the ecosystem is so open, and like I know that I reached out to you a couple of years ago when we met, and we've been interacting ever since. And it's not that we interact on a day-to-day basis, right? But I mean, we keep on chatting, you keep on sharing your ideas, I keep on sharing mine, and that's how the ecosystem is. Like the biggest founders, investors, like if you reach out to them with the right intent, they would give you a time, they would want to learn from you, and vice versa. You also think about how you can kind of contribute to their lives as well. I think you also mentioned this on my podcast, that you're a big believer of serendipity, just reaching out, cold connects, writing emails to people. And I think that's one of the most powerful tools to kind of build your deal flow, build your relationships, build your network.
Yeah, absolutely. If I think one part I'll double down on is, and I do this if I've heard something great about a founder today, someone shared an image of, maybe their consumer brand, their store, this, that, just reach out with a short message. It Three things can happen: either no response, the second is you end up building a relationship where one can have peer-to-peer learning, and the third is you end up working with them. There's
Yeah.
nothing else that can happen. So I think it's all about building your ecosystem. Again, network is a very transactional term, but building an ecosystem is critical for you, for your ability to be a good angel investor as well, if you want to still use the word angel investments.
Amazing. And how, like across your portfolio, what have been traits of successful founders, and like how do you kind of evaluate an investment opportunity, when it's been presented?
A key trait of our founders is they're very aggressive, in terms of their own targets. Now, there can be a that's a double-edged sword, right? Sometimes one is being aggressive and saying we'll meet targets at any cost, and the second is our targets are always aggressive. That means we'll almost always be at 70-80% of our targets. That means we're always growing. I prefer the latter, obviously, because we want to have aggressive founders who are conscious about their growth. A key part of us evaluating these founders is understanding their ability to navigate the first 18-24 months if it's a early stage founder, which means navigation includes what kind of team are you going to build, what are you going to be your key, what's your one key goal, right? Not having too many, not getting distracted, because I think one thing we all know is it's very easy to get distracted and create 25 rupees across four products as opposed to creating 100 out of one, right? I prefer the latter strategy. So being focused and aggressive is a key trait on all our strong founders, all our winning founders. The other is those that have an ability to build incredible teams, and incredible delegation. Because as things get busier for you as a founder, as time gets busier, you have to start realizing that now it's no longer that garage that you were working out of, if that's the analogy you want to use. So these are key traits. I mean, these are key traits we evaluate as well. Obsession, obviously, is something that I've always harped on, and I'll believe that being obsessed about what you do is important, because this is a very long journey, both being a founder and an investor. So you have to obsess on your goal, not how you get there. And yeah, that's largely 3 to 4 key traits.
Amazing. I think, and guys, please feel free to ask your questions. If you have any, you can chat, raise up your hands. Happy to, take them. From my end, Sanil, I have two last questions. And I think before we started, Manav has mentioned something, so we can take that. You mentioned helping people at the exclusive party. That's a very interesting analogy. In addition to funding, are there any ways in which you help founders grow their business and scale up technology?
Yeah, that's a great question, Manav. And for me, I've always maintained that the best support you can give a founder, uh, firstly, is don't trespass and don't be too invasive in their business. We've trusted them with our capital for a reason. Um, but the support that you can really give a founder is uh, helping them build traction, just doing excessive business development for them. Because if you can help them build traction, you're helping them generate revenue. It's in the benefit of every single stakeholder. The second is, if you have a network and the founder is looking at fundraising, help them build the relationships with someone that's going to be a key deployer of capital in their company moving forward before they need it. We all know that the people pitch an idea, but it's not the pitching that wins, right? It's the relationship, getting to know the founders before time. So how do you help build those relationships, have that foresight that, okay, these are the 5-6 investors I think they should be speaking to, and 5-6 is just a number, could be 20. But have those conversations with your founder to say that, here, these are the two things I can do. For me, it's always business development and excessive fundraising. If your founder needs circumstantial support in hiring, if they need support in branding, let them approach you. I don't think we should, again, when we shouldn't be a part of you know their office dynamics, unless they want you to be. um, these are largely it, and this goes a really long way because you could be the smallest check on the cap table, but the support you're giving and helping change that PNL for the positive will be an will be something that founders will not forget. And I do want to say, without obviously being able to name anyone, I have been a very small check-in founders who have given me access to exits because they have realized that we have been there for them, and they have been there for us. That's just human nature, and that goes a really long way. Giving this support. So it's a great question you asked.
Amazing. Sanil, according to you, like what are three, four exciting opportunities, across sectors in India today?
I think a big part of India's growth journey and being the kind of consumption we're going to see is going to help commerce enablers. So I think there's a lot that's going to happen in further in supply chain and logistics. I think that's a really large area where further innovation could take place. You mentioned Celsius Logistics is one of our companies that's trying to cater to the cold chain logistics ecosystem, which is a very fragmented um, part of today. There are great players in the kind of logistics solutions needed for cold chain, and I think there's a lot to be done. The second area is healthcare. I think there's a lot to be done in healthcare. We recently backed a oncology chain. We've backed someone focusing on surgeries. I think healthcare has to be catered to because there's a class of paying propensity of India that needs organized better healthcare. So we are looking at healthcare as a very large part. Um, we're seeing a lot happening in certain stacks of sustainability as well. I'll sort of limit it to these three. Now, in sustainability, it is focusing on agriculture, um, be it in carbon emission tracking tools, methane emission tracking. So I feel there are solutions there. These are investments that will be longer to hold because there's going to be a long period of maturity, but they are significantly going to give a delta to investors. I firmly believe that those that can hold on to these investments, it'll just be the norm. It should be the norm today as well, to just make sustainable investments. So I feel these are going to be great sectors to look out for. And I think you and I both have a common love for consumer brands, so that goes without saying. I think brand plays will work, but a differentiation of who you're targeting. There are 3 to 4 different Indian consumption classes, right? You have to be very clear who you're targeting. I think the best consumer brands have to be the best content companies. There is room in these 3 to 4 areas.
Interesting. Are you guys also looking at generative AI, as an opportunity, or like maybe like funding deep tech companies?
We have, as long as the application is. So I think Gen AI, it all depends on the utilization of the application of it, right? We've not invested solely on the fact that it's a generative AI company. I think the application is very important, and we have to understand how we can propel the application.
Okay.
How can we, again, going back to the query that Manav had, how can we really enable? I'm not going to come and enable the tech, right? We can't do that. That's on the founder. That's sometimes they're using open source technology. Sometimes they're building something proprietary. That is their core competency.
Yeah,
But can we help develop their business? Can we help them create POCs? That's where we look at it. But yes, selectively we have, and we selectively will continue to.
amazing. Great. I think one last question, Sanil, like if you have to kind of look back at your journey and like like if you were to kind of learn from your mistakes which you've done over the last 7 8 years as an investor and give advice to young investors basis that, like what would that be?
Yeah, I don't want to say I don't want to look back. It's not that long. It's only been 8 years investing, but whatever little I can look back. See, I think one key win I want to tell you all to start acknowledging over time is it's okay if you have an anti portfolio, and an anti portfolio, for
Mhm.
this definition's sake, is something that you missed out on, right? Opportunities you've missed out on. If your anti portfolio is great, you're doing something right as well. That means those opportunities did come to you. Now,
Hmm.
sure, you didn't invest in them, and you can learn why you didn't, but it's okay to have an anti portfolio. One of my mentors had told me, he's like, you should not look back as an investor. Once you've invested or not invested, don't look back.
Hmm.
Because you can't get that decision back, you can't get that time back. So it's okay to I have a envious, and I wish I could name them, anti portfolio, and I have a great, I'm so lucky to have the founders and portfolio I have today. But my anti portfolio is incredible. I've joked that if there was a someone who backed my anti portfolio, they would be giving competition to the portfolio, and I think that's a learning. I gave myself a lot of shit for this. Okay, I'm being very open with you all. So now I don't. Now I've said, यार अगर ऐसे opportunities तब आए थे
Yeah.
when I was, finding it so hard to figure out where the opportunities were coming from. Sure, luck plays a very large part of everyone's life, but it did come. Now, as I'm working harder and harder to be the best enabler for my startups, maybe those opportunities will come again. The second part is, don't be anxious once you've invested. Now, I know it's very easy for me to say that. Anxiety is a big part of our nature. I mean, it definitely is of my nature. But you can't be anxious, because you'll be anxious if you have either no information or little information. If you have too much information and the right amount of information and you're still anxious, you're more likely to figure out whether you want to exit. How is that reason to be anxious as a holder relevant? Sometimes you have to make peace with it that iska kuch nahi ho sakta hai. If you have zero or little information and you are consciously doing that, then that's your decision. Then being anxious is actually going to be a part of it, because now you're thinking about your capital. You're not thinking about appreciation. You're saying, "Maine itna dala tha." I'm telling you things that I've done, right? And then itna dala tha. What's happening with that capital? Oh, why is it not growing? Boss, go out there and just get that information. It's very easy to. So these are two things. And the third is just, I mean, I say this in anything I do, just have fun when you're doing it. We are part of ideas that turn into ideas that turn into businesses that turn into brands. It's a fascinating journey.
Yeah.
You're a part of something that is a speck of, a drop of water that can become an ocean. Just think of what you could be a part of, what possibly help way beyond capital. That idea is enough to just have fun in this whole ecosystem, and know your means. Lastly, they say know your means. Don't have FOMO in investing. So don't overburden yourself, over capitalize yourself. Yes, there's risk to this. There's unbelievable rewards to this as well when they come. So everyone's ability to double down, increase how much they're doing can happen. People might say, oh, 2024 the best time है invest करने का. That doesn't mean another 20 to 24 event won't come. If
Yeah.
you feel you can put in 10 rupees today, don't put in 20. Enjoy with the 10. If you feel you're going to miss out on this journey, I can assure you this will come again. This is the best. India is the best place to be. India is the best place to invest in. You're not going to miss out on the journey. So learn from it, be patient, because that's really what pays off.
Amazing. Thank you so much, Anil. Like really valuable advice. Thank you so much for your time. Had a great session. We wish Huddle the best. In your journey. May you back more iconic brands, enablers, companies, founders, right? And like from Fund One, Fund Two, Fund Three, and many more funds. Like wishing you guys the best.
Thank
So,
you.
and like thank you so much for like collaborating and giving back to the community. So
I love what you're doing, and wishing everyone here the best. And I think you're doing a stellar job for the ecosystem with Accelerate. So thanks for having me, and I highly appreciate you with all the questions that everyone's asked and what you've asked.
great, thank you,
Super.
thank you everyone, have a good day.
Great. Have a great weekend.